Hey everyone, welcome back to Corporate Decoder. Today, L.U.N.A.I Bioworks Inc. just filed their quarterly report, and I am seeing some major shifts in their financial health. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is clearly making some big moves, including a massive reverse stock split. And the financials tell a wild story about where they might be heading. Alright, let's dive into L.U.N.A.I Bioworks' latest quarterly report. This is essentially their update on how they are doing financially over the last 3 months. The big news right out of the gate is that they are preparing for a significant change. They just announced a 1-for-8 reverse stock split. Now what does that mean? Imagine you have 8 slices of pizza. The company is going to take those 8 slices and turn them into one bigger slice, but you still have the same amount of pizza. For shareholders, this means their number of shares will decrease significantly, but the idea is that the price per share will go up proportionally. Companies often do this to boost their stock price, especially if it has fallen too low, and in L.U.N.A.'s case, it is to help them stay listed on the Nasdaq stock market. Historically, many smaller companies that do reverse splits eventually see their stock price fall even further, and about half of microcap companies doing this end up delisting eventually. Think about Kodak back in 2021. They did a 1-for-20 reverse split and holders saw about a 40% additional drop over the following 90 days. It is a move often made when a company is struggling to maintain its stock price. Now let's look at the actual numbers on their balance sheet. As of the 31st of March 2026, the company had total assets of nearly $10 million. That is up from about $8.2 million at the end of June 2025. The biggest reason for this increase is a jump in their cash. They went from having just over $92,000 in cash to over $3.1 million. That is a huge improvement in their immediate cash position. However, when we look at their liabilities, which are the debts and obligations the company owes, we see a significant decrease. Total liabilities fell from about $29.5 million in June 2025 to around $19.4 million by March 2026. This is largely due to a big reduction in what they owe to related parties and a drop in their contingent consideration liability. This means they've paid off or settled a good chunk of their debts. But here is where it gets interesting. Despite the increase in assets and decrease in liabilities, they still have a stockholders deficit. This means that if you add up everything the company owes, it is more than everything it owns, and that negative number is still quite large, though it has improved. It went from a deficit of over $21 million in June 2025 to about $9.5 million in March 2026. So they are digging themselves out of a hole, but they are still in a deficit position. Now let's look at how the company performed in terms of making money and spending money. For the 3 months ending the 31st of March 2026, they reported about $21,000 in service revenue. This is new revenue for them, as they had zero service revenue in the previous year. They did have a gross profit of about $21,000. However, their operating expenses were much higher, leading to a loss from operations. For the 3 months ending the 31st of March 2026, their loss from operations was about $1.4 million. This is a big improvement compared to the same period in 2025, when their loss was over $4.1 million. The reason for this improvement is a significant cut in their general and administrative expenses, which dropped by about 66%. That means they've really tightened their belt on day-to-day operations. When you look at the bottom line, the net result for the 3 months ended the 31st of March was a loss of about $2.5 million. This is worse than the previous year when they actually had a small net income of about $189,000. The main reason for this increased loss is a big drop in other income, primarily due to changes in the fair value of contingent considerations and a loss on debt extinguishment. For the 9-month period ending the 31st of March 2026, their net loss was about $1.5 million. This is a massive improvement from the same period in 2025, when they had a net loss of over $51 million. This huge reduction in the net loss is largely due to a massive decrease in goodwill impairment, which was over $47 million in 25, and a gain from the bankruptcy of a subsidiary. Now, this next part is really important. In the notes to the financial statements, they address their ability to continue operating. They state that these conditions raise substantial doubt about the company's ability to continue as a going concern for 1 year after the date the financial statements are issued. This is a formal way of saying they might run out of money. They have had significant losses and rely on getting more funding. This is a major red flag, similar to what we've seen with companies like Bed Bath & Beyond or Rite Aid before they faced serious financial trouble. Without new funding, they may have to drastically cut operations or even seek bankruptcy protection. This section discusses how they value certain assets and liabilities. They mention a contingent consideration liability, which is basically an amount they might have to pay in the future, depending on certain events. As of the 31st of March 2026, this liability was down to just $50,000, a big drop from $630,000 in June 2025. This indicates they have either paid off this potential obligation or the conditions for it are no longer likely to be met. Here we see the impact of their acquisition of Biosymmetrics. They've recorded goodwill of nearly $6 million, which represents the value of the acquired company above its identifiable assets. They also have intangible assets like software and trademarks. The company has started to amortize or spread out the cost of these assets over time. This is a critical section for understanding L.U.N.A.'s financial situation. They have a lot of different types of debt. They mention convertible notes that are being converted into stock and various promissory notes. What is striking is the activity around debt extinguishment. They report a loss on extinguishment of debt of over $1 million in the 3 months ending the 31st of March 2026. This often happens when a company pays off debt early or exchanges it for something else, and the terms make it a losing proposition financially at that moment. They also mention several instances where they exchanged outstanding promissory notes for shares of common stock, effectively converting debt into equity. This is a common strategy to reduce debt, but can be very dilutive for existing shareholders. This section shows the activity in their stock. They had a lot of share issuances, including through their at-the-market or ATM offering, which raised about $4.5 million. They also issued shares to settle debts and for services. The reverse stock split we talked about earlier is also reflected here, where they adjusted past share counts to reflect that future split. As of the 31st of March 2026, they had over 35 million shares outstanding. L.U.N.A.I also recognized stock-based compensation expense, which is the cost of giving employees and directors stock options or awards. They had about $169,000 in stock. Base compensation for options in the first 3 months of 2026 and close to $500,000 for the 9-month period. This is a non-cash expense, but it does represent a dilution of ownership for existing shareholders when those options are exercised. This is where we find out about lawsuits and other potential problems. L.U.N.A.I is involved in several legal proceedings, including securities class action lawsuits and derivative litigation. These lawsuits are quite serious, alleging false and misleading statements and breaches of fiduciary duty. While there are ongoing settlement discussions, the outcomes are uncertain and could result in significant financial penalties for the company. They also filed a lawsuit against alleged naked short sellers, which is an interesting move aiming to recoup damages from what they believe were manipulative trading practices. This section details their acquisition of Biosymmetrics Inc. back in April 2025. The deal was valued at over $6 million paid for with L.U.N.A.'s own stock. This acquisition is a key part of their strategy to become an AI-driven biotechnology company. The goodwill recorded from this acquisition, nearly $6 million, reflects the premium paid over the fair value of Biosymmetrics' net assets, suggesting the company's belief in future synergies and growth. Looking ahead, this section covers events that happened after the reporting period. They completed another acquisition of NeuroBridge IP Holdings Incorporated, paying with Series B convertible preferred stock valued at $20 million. They also approved another reverse stock split, this time a 1-for-3 to 1-for-30 range, and then selected a specific ratio within that. They also filed that lawsuit against alleged naked short sellers. This shows they are actively trying to manage their stock price and address perceived market manipulation. Then, perhaps most importantly, they completed the acquisition of NeuroBridge IP Holdings Incorporated on May 1, 2026 for $20 million worth of Series B convertible preferred stock. This is a significant amount and indicates aggressive growth strategy. Management's discussion section confirms the company's focus on AI and biotechnology. They are still in the preclinical stages for most of their therapies, meaning they haven't generated significant product revenue yet. The service revenue they did recognize is from a single customer and is not enough to cover their operations. They reiterate the going concern warning that they need additional funding and face substantial doubt about their ability to continue operating for the next year. Looking at the operational results, revenue is minimal, mostly from that one service contract. The significant changes in expenses are largely due to one-time items like goodwill impairment in the prior year and lower general and administrative costs in the current year. The net loss for the 3 months ending March 2026 increased compared to the same period in 2025. Mostly due to changes in how they account for future potential payments and debt dealings. However, the 9-month period shows a massive reduction in net loss, largely because of that huge goodwill impairment charge disappearing and a gain from a subsidiary's bankruptcy. This section reinforces the financial challenges. They have minimal cash flow from operations and are heavily reliant on external financing. The increase in cash to over $3.1 million is positive, but their working capital deficit is still over $15 million. This means they owe much more in short-term liabilities than they have in short-term assets. Despite paying down some debt, their overall financial position remains precarious. Here is a really telling piece. The company states their disclosure controls and procedures were not effective. The reason given is that they do not have adequate resources to address complex accounting matters. This is a significant internal control weakness. It means that even with the best intentions, they may struggle to accurately report financial information, which is a foundational element for investor confidence. They expect this to continue until they have more capital to hire appropriate staff. The legal proceedings section is extensive, detailing ongoing class action lawsuits and derivative actions. These stem from past alleged misconduct and could result in substantial financial payouts. The company is actively defending itself and also suing third parties like those alleged naked short sellers. This legal quagmire adds another layer of risk for investors. This lists all the documents attached to the filing, including agreements related to their acquisitions and debt exchanges. It shows a consistent pattern of restructuring debt and acquiring smaller companies. Finally, the report is signed by the CEO and CFO, acknowledging their responsibility for the information presented. Overall, L.U.N.A.I Bioworks presents a mixed picture. On one hand, they are actively working to clean up their balance sheet, reduce debt, and improve operational efficiency, as evidenced by the reduced operating losses and lower liabilities. The acquisition of Biosymmetrics and the planned reverse stock split indicate a forward-looking strategy. However, the going concern warning and the disclosure controls not effective statement are serious red flags. They are in a race against time to secure more funding and navigate significant legal challenges. The reverse stock split signals a fight to stay in compliance with Nasdaq rules, which is often a precursor to further financial difficulties. The risk I am watching most closely is whether they can secure the substantial funding they need to continue operations and avoid bankruptcy, especially given the historical performance of companies that undertake reverse splits. Oh, and the research tools I use to pull this data are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.